Are all investors knowledgeable about short sales and all homeowner options?
I would say that most investors are at least familiar with the short sale solution, most homeowner options. I wouldn't say that all investors are experts in short sales. It does require a great deal of training and education of the process, as well as staying abreast of bank policies, which have been changing quite often. You know, some of the larger lenders have had major policy changes just in the last month or two. In fact, in the last week, there have been major policy changes by two large lenders. So it's important to stay educated on the process if you are going to pursue short sales.
Chart on there. What is a mitigator?
Okay, a loss mitigator is a negotiator who works for the bank, and that mitigator will work towards mitigating the loss on the loan for the lender. So that is a representative to make sure that they collect all of the paperwork. So there's the financial package, which includes bank statements, tax returns, you know, pay stubs and a hardship letter, as well as documentation on the actual contract itself, settlement statements, and other documents, listing agreements that are required as part of the package. It's the loss mitigator's job at the bank to put that package together, make sure it's complete, and then it's processed then by, or at least a decision is arrived by either the loss mitigator, or it's then sent on to a committee or management for final decision on the acceptance.
Now, what I've experienced in the past is that some agents or investors that aren't experienced enough in the processing of the short sale may not get all the documents in on time.
Correct.
And so what does that do to the short sale process?
Well, an incomplete package actually stalls the process, and it frustrates the loss mitigator at the bank. Loss mitigators are overwhelmed with files nowadays. Some loss mitigators have 200 to 300 files that they're actually managing, and they've got to have so many touches every day. If a file is not complete, the loss mitigator can't move forward on that file, and it stalls the process. And in some cases, the file is just denied because it's incomplete. So it's really important that a complete file is submitted to the lender in one submission, not piecemeal over time, because it's very difficult for the lender and the loss mitigator to accumulate all the documentation and make sure it's complete. Therefore, a lot of times those files end up falling off to the wayside.
Yeah, and we've seen that where you work a few months with trying to get the short sale processed, and then papers are missing because they didn't put the right papers with the file. Now, each of the banks has similar documents, but some of them have their specific documents. What are some of the documents that are going to be needed, and when is it advisable for the homeowner to fill out those forms? Because they have to be done quickly.
Absolutely. It's important that the homeowner completes the financial package that's required for the lender. Each lender will provide a list of documents that they require for a short sale application. Those documents will include a hardship letter where the homeowner will explain their hardship situation in detail so that the lender, if they have any questions, can always contact them back to the homeowner, but they should have a complete story of what caused the default. It's also important to make sure that the reason for default is very clear and that there are no references or inferences that it may be a strategic default. So therefore, it must be a long term. The second document that's usually required by the lender, and some lenders require their own documentation. It's the same information, but with their letterhead. But there's a financial statement which lists their typical monthly budget, which includes both income as well as all the expenses for the household, income received on properties if it's a rental, as well as any expenses. After that, the homeowner will also be required, in most cases, to supply bank statements, pay stubs, and a minimum of 1 to 2 tax returns. And if you're self-employed, that may even include providing a profit and loss statement for the last 6 months or a year to date, P&L, or profit and loss.
And the bank statements, usually about how many months back do they want that?
Usually 2 months, but sometimes as long as 6 months.
Okay. So hopefully they've saved all their pay stubs.
Yeah, and not only do they want 6 months, but as the file progresses over time, the banks will also ask for updated bank statements. So it's important that the homeowners keep their bank statements, even though they may not have any activity in it. You know, some folks who are going through an extended period of unemployment don't have a lot of deposits, or sometimes they just close the bank account. It's still important to make sure that if you continue to receive those statements, that they can show that to the lender, that all of a sudden there's not a sudden increase in income.
Mm-hmm. And would you say that sometimes they're asking for the documents 2 or 3 times? And usually just before it's going to close,
yeah.
At that point, they definitely want updated information.
Yeah, it's not uncommon for the bank to request updates of financials, and sometimes right before the final decision or acceptance is approved, they will ask for a final set. And in some cases, they actually may run their credit.
And in your opinion, what are some of the problems that could arise, either the appraisal or maybe the seller not qualifying?
Well, typically in the cases that we work on, the sellers are usually qualified for the actual short sale. However, in the market that we're in today, we're in a declining market where values continue to decline, at least that we see here in Chicago, or the values may decline 1% to 2% a month. When you're working with a loss mitigator who may be working out of an office in Dallas or California or Florida, they may not see local market conditions, whereas the realtor sees the conditions in the marketplace on a daily basis, just as we do. So in a declining market, the lender is relying on past sales and closed sales to make their decisions. However, the values continue to decline, and so they're actually relying on older information. And that's one of the problems you have with appraisals, or what's called a broker's price opinion. They may order one at the beginning of the process, which reflects the value at that point in time, but may not reflect the value when the property actually closes, and therefore the appraised value for the buyer will maybe less than what the appraised value is that the bank loan that relied on, mm-hmm. you know, for the extra short sale.
Mm-hmm. Yeah, in the normal market, we were going back 6 months as realtors to do analysis, yep. market analysis on properties, and now the banks are actually requiring less time, about 3 months.
Yep.
And then they're also adjusting for that period. And Dave, what is the homeowner released from all liabilities from the loan?
Well, one of 2 things happens when a short sale is accepted. On the one hand, the lender may provide them full satisfaction, which means that on their credit report, they'll actually show satisfied at less than full value. That allows the homeowner to walk away without any additional liability. However, in those cases, a 1099 is usually filed by the lender with the IRS, and so therefore there might be a tax liability for the homeowner. Now, whether that homeowner is a primary homeowner or the property was an investor-owned property, their tax situation is going to be different. There's actually a recent law called the Mortgage Forgiveness Act of 2007, which protects primary homeowners in a situation where there is a 1099 filed and allows them to walk away from a tax liability as well. However, in the other scenario, where there is actual deficiency judgment or deficiency that's going to be pursued against the homeowner, so the loss to the lender, they may pursue that loss or that lost balance or still outstanding balance that was not paid off at the short sale closing. That is a deficiency balance that the lender may pursue in full or part. In some cases, the lenders will actually pursue deficiency on just the balance of it, and really this goes back to the default situation and the actual hardship. So it's very important that the homeowner provide detail of their hardship, because if the lender will pursue deficiency against them, that may help them avoid a deficiency judgment against them because they just don't have the means to pay back the loan. So that's why it's very important to go into detail as to your default and certainly prove that it's not a strategic default, because there will be deficiency pursuit or judgment pursued against them if the bank finds out it's a strategic default. Mm-hmm.
And how does that differ from a foreclosure and the balance due on that?
Well, in the case of a foreclosure, you're going to have a larger deficiency balance because the property was not sold or not short sold. In the case of a short sale, the deficiency is minimized because they're selling the property at a higher value. Since in the case of a bank-owned property or the mortgage is actually foreclosed on, there's going to be a larger loss to the bank, and therefore there's going to be a larger deficiency judgment. So usually what happens in those cases is the banks will pursue a full deficiency against the homeowner. Some homeowners are forced to file a bankruptcy because they don't have the means to pay it back, or the bank will pursue a promissory note in some cases. It really depends on the lender as well as the hardship of the homeowner.
Mm-hmm. Okay. And should a seller always seek legal and financial advice to help them with the short sale?
Absolutely. We advise all homeowners to seek legal as well as accounting and tax advice from the respective accountants and attorneys before making any decisions, before pursuing the short sale solution or even the deed in lieu solution. So it's very important that they make an educated decision.
Okay, great. And three of the most common options lenders use to pursue against a homeowner are the 1099 debt forgiveness, the deficiency judgments, and a promissory note. Can you explain the differences?
Yes, with the 1099, a lender is providing satisfaction on the homeowner's credit report, which is a great solution for the homeowner because that will allow them to gain a fresh start and get back on their feet the fastest. However, with the 1099 being filed by the lender, a 1099 actually is reported as income to the homeowner, and so therefore it's important that they document the entire process, their mortgage, as well as what the mortgage was used for, so they can prove and they should be able to avoid any tax liability if it is a primary mortgage because of the Mortgage Forgiveness Act of December 2007. In the case of the deficiency judgment, the banks will pursue a deficiency in the case of a short sale or in the case of an actual foreclosure, and they're guaranteed a deficiency judgment almost in every case with the foreclosure. But in the case of the short sale, it really depends on the lender's policies. Again, we know that there are certain lenders, there are a handful of them that will pursue deficiency against the homeowner, and that homeowner will be liable for the balance of the mortgage that was not paid off, at closing.
And we want to recap now what we just discussed about the short sale process, how long it takes, and how the homeowner can help get the documents to the investor, to the real estate agent to negotiate the sale for them, and the homeowner's liability from the loan. And then we also discussed the advantages of having an investor negotiate on behalf of the homeowner.